Have you felt like something big is about to change, but you're not sure what it is? Well, you're not wrong. Right now, behind the scenes, our entire economy is shifting, and most people don't even realize how deep it's going. From the risk of a major recession, rising prices, global trade battles, and market uncertainty, to shocking trends in housing, stocks, and crypto. We're heading towards a financial storm that could affect your money, your job, and your future. But here's the good news. While most people will panic or sit on the sidelines, you'll have the knowledge to stay one step ahead. In this video, I'm breaking down exactly what's happening, why it's happening, and most importantly, how you can protect yourself and come out stronger on the other side. You'll learn surprising facts the headlines aren't talking about and real insights that could help you turn uncertainty into opportunity. So if you want to know the truth about where things are headed and how to stay in control, stick with me until the very end. What you hear today could seriously change the way you think about money forever. In just a short while, we're expected to witness a wave of major economic shifts. From rising import fees to growing prices, tighter wallets, and yes, the one topic that's making everyone uneasy, a recession. By definition, a recession means two back-to-back quarters of shrinking economic output. But here's what most people don't realize. You rarely know you're in a recession until it's already behind you. History shows there's usually a delay of over 7 months between the moment the economy slips and when officials admit it happened. That means if the slowdown has already started, the public won't hear about this until late this year. Why such a long wait? Because the official call comes from the National Bureau of Economic Research, and they don't just look at one number like GDP. They track deep, widespread drops in areas like production, employment, income, and more. And they need to be absolutely certain before they say the word recession. This is why major firms like Goldman Sachs are speaking up now. They're seeing warning lights flash from falling business confidence to consumer pullback. Even policymakers are signaling they're okay with short-term economic pain if it means long-term gains in their agenda. Other institutions like JP Morgan are echoing the same concerns. Nearly every economist they polled agreed recession risks have gone up, especially in light of added trade tensions and tariffs. And it doesn't take a financial genius to see the signs. Shoppers are holding back, companies are slowing down, and early year economic growth is crawling at just 0.3%. So what's the bottom line? Trouble might be brewing, but when you're aware, prepared, and thinking ahead, this could be your moment to rise while others are caught off guard. Recent forecasts show the economy might shrink by minus 2.8%, and all signs are pointing to one clear direction. A slowdown is becoming more and more certain. Even from personal observation, it's clear people are spending less. Investors are pulling back. Some of the richest individuals are moving their money into cash reserves or low-risk accounts. Why? Because the one thing the financial system fears the most is not knowing what's next. Now let's talk about how long this could last. Since the 1940s, there have been a dozen economic slumps in the US. The shortest was just 2 months long, while the longest dragged on for a year and a half. On average, a downturn usually sticks around for about 10 months, and it tends to shake up everything. During these rough patches, the first hit usually comes to jobs. Businesses expecting smaller profits begin cutting costs, which often leads to layoffs. Next, wages drop. A study from 2009 found that when unemployment rises by just 1%, average salaries fall between 6 to 7%. And even after 15 years, many workers still earn about 2.5% less than before. Another thing that slows down is private business investment, as companies get more cautious about spending. But now, let's flip the perspective. If you look at the stock market, you'll notice a pattern. Over the last 11 downturns, share prices usually reach their peak about 8 months before a recession is announced. The market typically drops around 30% during that window. So, if stocks hit a high in February and a recession is confirmed in November, that lines up almost exactly with the average delay of 7.3 months between real conditions and official statements. Here's the surprising part. A recession alone doesn't clearly tell us how the stock market will behave going forward. I'll be honest, I didn't expect this either, but here's what the numbers actually reveal. From 1869 to 2018, there were 16 economic downturns where the stock market still went up. On average, shares climbed nearly 10%, even as the overall economy shrank by about 3%. That means, out of 30 total recessions, there's been no consistent link between market drops and economic slumps. Even when you include the COVID crash, the average return stayed positive at 1.7%, showing that stocks have historically remained strong despite the chaos. But there's a twist. Even though prices usually finish higher by the end of a downturn, the road there can be rough. The typical decline during recessions still hits around 29% before recovery kicks in. But here's the encouraging part. Once a recession ends, things tend to bounce back fast. History shows that in 85% of cases, stock investors were up after 1 year, and after 3 years, returns were positive every single time. In simple terms, recessions often turn out to be one of the best times to invest, because when fear fades, investors rush back in, and that surge pushes prices higher. The longer you stay in, the better your chances of seeing real gains. Now, let's shift to the one area that's on everyone's mind: housing. Surprisingly, home prices have held up incredibly well through most recessions, except during the 2008 crash and a short period in the 90s. In fact, real estate has often protected people against inflation, climbing almost every year regardless of what the economy was doing. Why is that? One reason is interest rates. During recessions, rates usually fall, and that allows buyers to afford larger loans, which helps push home prices back up. On top of that, most homeowners today are locked into low-rate mortgages, which means they're not in a rush to sell. Even more interesting, around 40% of homeowners don't have a mortgage at all. So the chances of a flood of desperate sellers all listing their homes at once, very slim. According to a 2023 report by Mark Woodworth, for home prices to drop meaningfully, we'd need either a massive drop in demand or a huge surge in supply. How big? He says demand would have to fall 50%. Just to match normal historical slowdowns, which seems unlikely since sales haven't dipped below 2 million in over 4 decades. On the supply side, yes, we could see more listings, especially from owners stuck with mortgage rates above 6%, but that shift won't happen overnight. In fact, as Mark points out, a big share of today's housing inventory was purchased by private buyers. As real estate prices climb faster than rental income, some may see this as a smart time to sell, especially those who bought vacation rentals, hope to flip quickly, or are now facing rising insurance and tax bills. These pressures, while local in some cases, could lead certain owners to exit the market. Now, when it comes to rent, you might expect a drop during hard times, but the reality is different. Rents usually hold steady or even go up during downturns. That's because fewer people can qualify for home loans, so rental demand stays strong. Unlike fast-moving markets like stocks, housing tends to stay steady. Since people don't move often, most homeowners keep their properties during tough times. Unless something big changes, we'll likely see more price stability than sharp declines. According to expert Ben Carlson, home values have only dropped in 7 of the past 50 years, and 5 of those were tied to the 2008 crash, a unique event that's no longer a major risk. That's why forecasts still expect growth. CoreLogic predicts a 3.6% increase, Zillow sees 6%, and Redfin expects 4%. Largely because high-income buyers can still afford most listings. Now let's talk about trade conflicts. Tariffs have become a back-and-forth strategy. One country makes a threat, markets react, and then there's either a delay or deal. Prices fall, bounce back, then shift again. This cycle has created short-term chaos, but it's all part of a longer pattern. For example, Israel recently removed all tariffs on US goods to avoid facing penalties, and more countries might do the same. Still, some will resist, and this back and forth may continue all year. Even with all this uncertainty, investing during downturns has proven highly rewarding. Data from the Motley Fool shows that since the 1940s, we've seen 48 market drops of 10% or more, about 1 every 20 months. Only 12 became deep bear markets. And aside from 2008, in almost every case, stock prices were higher 1 year later, and 60% of the time, they recovered within 3 months. One thing people get wrong is expecting average returns. A blog from Wealth of Common Sense showed that the market rarely returns at 8 to 12% in a year, only 5 times since 1926. In fact, big gains or big losses are more common than average years. Only 18% of yearly returns fall between 5 to 15%. That's why smart investing is about the long run, not months or even single years. The ups and downs will happen. It's staying in the game that counts. So, if a recession does come, your biggest risk isn't what's happening to your investments, it's whether you can keep earning consistently. If your income holds steady, you can keep buying through the dip, and that's where real growth happens. Honestly, for most people, the biggest thing to focus on is simply keeping your income steady. If you can do that, history shows you're likely to come out ahead in the long run, with solid gains over time. This video is for educational and informational purposes only and should not be considered financial advice. I am not a financial advisor, so always do your own research and consult a professional before making any investment decisions. Your journey to financial freedom continues, and I'm excited to be a part of it. Here's to your investing success. Profitable investing.